Hello, everybody. Kirk Spano. It is Monday, April 7th, several days after Liberation Day. Is that what they called it? Was it Liberation Day? And stock market has been down a lot globally. Southeast Asia got destroyed this morning, last night for them, last night for us, this morning for them. Maybe yesterday morning for them. I don't know, something like that. But Southeast Asia just got destroyed. 7, 8, 9% drops almost across the board. And there's starting to be some very interesting opportunities globally. But we have to let this dollar go up a little bit higher. All right. So what is going on in the markets? Well, we have some green stocks and we have some red. So right now, the market is trying to figure out what it wants to do. Bitcoin is down 4,000, broke that 80,000 level. I have orders in to sell IBIT puts. Oh, this has to drop another 10 or 15% before those would click in. SPY is down, 2.5% again? For a hot minute, it's only down 0.5%. And it's been moving today. It was up for a little while. Yeah, can't decide. Look at that. Quite the rally and then gives it all back. So I think there's a lot of traders being traders. What we saw on Friday was retail poured into stocks, buying stocks and ETFs on Friday, which I think was quite a bit early. What have I told you, or what have I said? I'd like to see your answers in the chat. I want to see how well you've been listening. What have I said about these tariffs and the potential for a recession? What have I been saying? I want to see if it's been resonating. Has it been sinking into the melon? What have I said about Trump and tariffs and U.S. debt and recessions? Give me the summary. I'll wait. What has been my message about Trump, tariffs, U.S. Treasury market? What have I been saying the most likely scenarios are? We'll explain it again. We have $6 trillion of debt due this year, about 7 trillion next year, about 8 trillion the 2 years after that, and 9 trillion the 2 years after that. And that is based on the actual debt coming due, plus financing the deficit, plus borrowing to pay the interest. So we will essentially be running way over 100% of revenues through the end of the decade because we don't have any other solution. It's either raise taxes on the 1%, in particular the corporations or the people who run the corporations, which we don't seem to want to do, or slash Social Security and Medicare, which would just put those people on welfare. So what's the difference? Or find another way to raise money, because there really just isn't that much to cut in the federal budget. I know that people want to say waste and fraud and abuse and overblown government and bloat and blah, blah, blah. And when they fix that, because it does seem like they're breaking things in order to fix them, you end up saving 2, 3, maybe $400 billion a year. And that's with an initial upfront investment in technology. Without the investment in technology, it's just firing people for the sake of firing people. Now, we know that the leak in government was some single-digit percentage of government spending. Now, people want to say, oh, it's half, it's 30%, it's 80%, it's all in government. Bullshit. You're zucked in the head if that's what you think, because there's no empirical evidence that that's true. None. Zero. It's a single-digit percentage of government is misallocated, and you can find all sorts of different reasons for misallocation. It can just be a bad organizational chart, which is typically the case. It can be fraud, which there's definitely some of that. It's not as overwhelming as some people want to make it out to be. And there's just bad contracts that have run their course and they need to go away. So, okay, let's suppose we save a couple $100 billion a year. The annual deficit is way over $1 trillion, right around 2 trillion, which means that if we cut taxes, which have not paid for themselves since the 1960s, right? Tax cuts paid for themselves one time. And that's when John F. Kennedy did it, because tax rates were super high. And he cut them and they actually did pay for themselves. And remember, he had the tailwind of rebuilding after World War II. When Ronald Reagan cut taxes, they did not pay for themselves. When George W. Bush cut taxes for the rich, and I say for the rich because 80 to 90% of the tax breaks actually do go to the top 1%, maybe top 2%. I benefit from a little bit of that. And I am not a 1%er. When Donald Trump did his tax cuts, they did not pay for themselves. And if they do tax cuts again and they extend his tax cuts, they won't pay for themselves this time either. Historically speaking, it is virtually impossible to cut already low taxes to have them pay for themselves. You can cut high taxes and they pay for themselves, but you can't really cut what are really low to middle taxes, globally speaking, pay for themselves. And given the demographics, the fact that Social Security, which you should think of as a pension, not an entitlement, the reason they call it an entitlement is to make you hate it, but it's really your pension. At least it's your subsistence pension, right? It's the minimum amount you get for having worked. And Medicare, which in America is the most efficient healthcare system that we have. It's more efficient than the VA or Medicaid by far. It's more efficient than United Healthcare or Blue Cross Blue Shield or any of the private plans. Medicare, because it incorporates a supplement, which is from a private insurance company, has the best of both worlds. It's universal coverage, which allows there not to be a lot of waste because people just run to the ER when they get sick rather than doing primary care. But with the private supplement, you get choice and quality because the supplements will pay more than what Medicare generally allows. So the reality is that the waste in the government is from other things. Now, if you don't think that we waste anything on the military industrial complex, fine, go ahead and make that argument. I'm not going to argue with you. I disagree, but I don't think that's egregious either, given we live in a dangerous world. I think it really just comes down to organizational chart. I think it comes down to some bad contracts. I think it comes down to some grift and then some fraud. A couple $100 billion a year, maybe $300 billion a year, maybe $400 or $500 billion a year, but probably not. So when I talk about Trump's tariffs, to jump forward, and I say, okay, what does this mean for the economy? It means that at a minimum, we're going to get a recession scare. That's what we have right now. Everybody's afraid of a recession. Does that mean we're going to get a recession? No. Do I think we're going to get a recession? Yes. And the stock market, if we have a recession, will suffer because earnings will get revised downward. We're about to see that start in a week. The earnings revisions that you're about to see are all going to be to the negative side. The next Fed meeting isn't until May 7th. I don't think that they're going to cut rates before then. They might not even cut rates on May 7th. If they do, I think it's only a quarter point. I think President Trump has made his bed. He's going to lay in it for a while. And if the Treasury market dries up in the second half of the year, which I think it will, then we may get quantitative easing by the end of this year. The first batch won't be called quantitative easing, and Congress won't be involved. It'll be a bailout of the repo markets, maybe some other things. Don't call it QE, call it a special facility, right? That's what they called the last one and the one before that. So when the banks went under a couple of years ago, special facility. When the repo market went under in September of 2019, special facility. They really don't want to call it quantitative easing because it has a negative connotation now. But let me ask you, with $12 trillion of financings over the next 2 years, and then $14 trillion the 2 years after that, and then $16 trillion or $18 trillion the 2 years after that, where else are they going to get the money? If retail investors are pouring in the stocks and ETFs as of Friday, and at least some of them were this morning, whose money is getting pulled out of the system? Who have we really pissed off? Somebody said institutional. Nah. Institutions are a little scared, but they don't do giant reallocations, right? They move a few percent at a time. So a bunch of people are saying foreign investors, and that's exactly right. So foreign direct investment is falling, not increasing. President Trump can tout a couple of big deals all he wants, but really all they are is small add-ons to existing things that were going on for the last 5, 6, 7, 8 years anyway. The majority of the planned new investment that we've heard about in recent headlines was already happening as of the last 2, 3, 4 years. Made those plans during the Biden administration and before COVID. Apple, the one that they announced with Apple, it's just an add-on. It was like a 10% add-on. Taiwan Semiconductor was like a 10 or 15% add-on. And that would be normal that you would expect them to do that over time. Somebody brought up an argument on X, and I've seen it in a bunch of other places too, that, hey, if you're a corporate executive, think this through. Are these tariffs going to be there in 4 years? If there's a different president, Republican or Democrat? You're seeing the blowback from the Republicans. The reality is that we became a very rich country with relatively low tariffs. Now, does that mean that we shouldn't raise any of our tariffs? No, it doesn't. There are predatory players out there. There are countries, China being the main one, that subsidize their industry really on the back of the tariffs they charge our imports when they get there, and then they fight unfairly. It's not a true free market. It's not really based on comparative advantage because they are able to sell at a discount. It's called flooding the market. So targeted tariffs, which has generally been the policy of the United States, even though it's been lightly used in reality, is the right way to go. Now, if we want to have a universal import tax, which is what I think he's going for. I don't think we're going to see tariffs below 10%, except for free trade agreement stuff. How much can you raise? Well, based on the level of imports, 10%, depending on where we're at in a given year, it's a 9-figure number. It's not $1 trillion. This idea that we're going to raise trillions, it just doesn't play out in the math. You can go and use Perplexity. I did this recently. I just forget the number. Somebody ask an AI, what does America import in goods? And then ask it what we import in goods and services. And services are harder to tax. But goods, the number is only a couple $100 billion is what we get out of taxing those. Now, am I against a 10% universal import tax? I don't think so. I think that's a small enough number. It kind of mimics a VAT or a sales tax. I don't think it's good to raise the cost of living on the 80% of people who can't afford it. But if we truly do get a handful of jobs back here and we solidify our industrial base a little bit and just get the key industries back, which is all we really should be focusing on, right? Because who here wants to, make pants or shoes, right? It's just kind of silly. Robots, right? Spaceships, cars. Cars are a huge part of the economy. I get that part of it. But the blanket nature has been bad for our relationships with allies, and the enemies don't care. So the reality is that our relative position to most of the world is pretty darn good. And for us to do this on the back of rhetoric because we want a deal, the reality is we already had a deal. The dollar's been getting strong for over a decade. Since I said in Market Watch it would get strong for a very long time, because the relative strength of our economy is that good. Our problem isn't the strength of the economy. It is the way that we allow opportunity to be distributed and the way we allow gains to be distributed. We long ago could have raised the minimum wage and improved healthcare benefits, but then 1,000 executives would have made fewer bonuses and wouldn't have become billionaires. These are your choices, right? Your choices, my choices. How do we want to vote? Now, I'm not for higher taxes, to be honest with you. I just think that we need to fix the scale again so that it's more progressive. I think that we should keep the higher standard deduction because that's good for the folks who have a hard time saving in the first place. But as I have learned how to manage my money, as I've gotten more of it, and discovered how 1031 exchanges really work versus how they're intended to work, and carried interest, step up in basis, things like that. The reality is all the loopholes, all the incentives, all the things that we say are good for capitalism, not so much. New investment into new buildings, new factories, new whatever is good. But shuffling properties to recapture a tax break, that's what a 1031 exchange has become. It's garbage. You should be required to have to put money into development or redevelopment to get a 1031 exchange, as far as I'm concerned. Carried interest, if you actually write a check, then fine. If you're also working on the deal, private equity fund, whatever. But if they call your income carried interest so that you don't have to actually pay income taxes, which is what goes on, it's garbage. It's just a tax dodge. There's a lot of that out there. Capital gains being at a lower rate than regular income taxes only makes sense up to a certain number. It doesn't make sense once it's substantially above an already high income. I would say get a capital gains break on maybe the first $1 million that you make in a year. After that, it's just income. And when you die, you should have to pay the taxes. You deferred them your whole life if you haven't sold. Pay the taxes when you die. It used to be that you got 5 years to pay it in increments. I don't know if that's still the case because there's a step up in basis. That's how they used to do estate taxes. The tax code, since I got into this business 30 years ago, and there was a big change in 1982, 81 or 82, and then again in 86. The tax code has gotten progressively better for the top 1 or 2% of the population and really become more regressive for, I'd say, the bottom 60 to 80% on the income side. And by the way, wages have trailed inflation since the Reagan administration. There's only been a couple of times for a few years where that wasn't true. Under Obama for a little while, under Clinton for a little while, under Biden for a little while, and for 1 year under Trump. Mark that on a scorecard, see how it looks. So what is the market going to do the rest of the year? Boy, that's really what you want to know. I think this is starting to look a lot like 2018. However, if this thing drops another 10 to 15%, which is where we start to hit major support levels, then maybe it's 2022. But wait, the 2008 scenario is not out the window. If we get an actual recession in the second half of the year, not just a recession scare, and I've told you that I think a recession might have started already. Remember when I said, this is going to be the easiest way to find it because I posted it for my poker buddies. Oops, wrong one. There you go. So this was a topic of discussion at our main event for my poker league. This is going to be a little bit hard to see. But remember last month, 2 months ago, when I was in Vegas, I said that it was the least busy I had seen it since pre-COVID. Really since about 2019 or 18 or 19. Vegas is in fact turning over. I don't know how correlated that is to the economy. To me, it's just interesting because I've told you over and over again, when I go to Vegas, I look around. How busy is it? How freely are people spending money? And in February, it was pretty slow and people were not throwing money around, not like they were back in June. In June, I told you I played at a $25 craps table and a guy walked over, put $30,000 on a table. I'm just hoping not to crap out when he's got stacks of hundreds out there. And then I think to myself, he's got stacks of hundreds out there. Whatever, I crap out. I just want to win for me. And you know what? You have no control over the dice. So whatever happens, happens. We don't have a lot of control over what goes on in the economy. We voted for what's going on. I think some people are like, especially the ones who lost their jobs, are like, maybe that wasn't such a great idea. But I will tell you is this: history demonstrably shows that if this trade war continues for quarters and quarters on end or years, the odds of a depression have risen. I say that because I think it's important that you know that it could happen. I don't think it's going to happen, but the odds are not zero. And if we don't start to see deals and dramatic reductions in tariffs, and again, I think the 10% I think that's baseline. I think he's sticking with the 10%. And you don't have a free trade agreement with the United States. I don't think that 10% goes away. And I don't think the market has really wrapped their head around that yet. Oh, they're all just going to go back. No, I think that 10% is a baseline. Scott Bessent at one point said 3 to 5%. Well, in Trump speak, that's 10%. So you need to wrap your mind around the fact that there's pretty significant risk out there before you rush back into the market. And what is going to happen, and I've said that I expect a rally, what's eventually going to happen is we're going to get a rally. But if you just go back to 2016, which is what I think the relevant time frame is, right? That was the end of the sideways market. We established our trend and we broke above it. The trend line bent up. We are just about to hit my bullseye here, right? We're already down to 500 on SPY. I said middle 400s. We don't have a long, it's only 10% away. Now, if middle 400s doesn't hold, the next leg down is the 2022 lows, middle 300s. That means a lot of stocks can keep falling. I sold some cash secured puts on Friday. I popped those up in the chat rooms, and I will mention them in the article I'm writing tonight. I have to spend a few hours getting this real ID, or minutes. I don't really know how long it'll take. But another 10%-ish down should be a pretty firm support area. But if we break it, there's a whole nother leg down. So the reality is that, and you should be able to see this pretty well, you can see those little dashed lines. I don't think I can make those bigger. Yeah, there's not really a make the line darker sort of thing. But you can see that we're supposed to get a rebound. And I don't think it'll go that long. But at some point, we'll get a bounce. And you really have to think to yourself, okay, is it a V-shaped recovery? Or is it just a dead cat bounce and then another drop down? If the foreign direct investment doesn't come back, we have to do quantitative easing to pay our bills soon. I'm not sure this year, but pretty much for sure next year. As we've seen in Europe and other places in the world, if we choose to do austerity, then you get a depression. And the idea that we need a recession to get lower interest rates is just ass backwards. Trump really wanted to refinance the debt. He would go to Congress, but he's not smart enough to do this, I don't think. He'd go to Congress and say, look, I want to issue 30 to 50-year treasury bonds at 3% that the Federal Reserve buys and pays off over a very long period of time like a mortgage. And this money isn't for new spending, it's really to pay off our debts. And they create a structure to do that so that we get back to a baseline, but we don't get a sugar high. This isn't an original idea. This is easy enough. There's plenty of economists out there who have said this. I'm not the first one. There is a way to fix things. One moment, please. Just going to flat out turn off the telephone. People are zapping me. My son is moving into a new apartment and I might have to co-sign. In any case, everything is fixable. That's the good news. The bad news, they're just in the braking mode right now. And I'm not sure if they know how to fix things. So we'll see. Somebody posted something from Apollo's Torsten Slack. I haven't read this necessarily, but there is a way to fix this. Just a matter of will we or when will we, I guess, is the better question. I really think that we're going to break through this at some point. We might get a bounce off of it, but I think we're going to get down to middle 300s on SPY. I think we're going to retest, but not quite get to the 2022 lows. So maybe this area in here, maybe it'll get just under 400. But that's still 20% lower than today. So I put out the punch card dividend stocks today, and I will show you part of it. I don't want to show the whole list. And I put a little quick macro in there. I showed a chart, as I will do. Then I showed profile of treasury debt. This is the debt coming due. This doesn't include the fact that we're running deficits and paying interest. Next 2 years are pretty big, but we've been issuing 2-year debt just like Janet Yellen did. So that means some of it's going here and some of it's going here, mainly here. And then we're going to have the tax cuts that won't pay for themselves probably. So we probably don't have a lot of leeway here. Without the foreign money, we are in big trouble. There just isn't enough to raise with tariffs. So quantitative easing is the solution. How they structure it is important. They'll probably do it wrong. And then we'll just get a replay of the inflation. So after a recession, we'll get an inflation next. So during the recession, prices will go down and people say, see, it's deflation, it's not inflation, just like they did in 2020. And then by the end of 2021, we had inflation. Same thing will happen now. We'll get a contraction where everybody goes, see, there's no inflation. and then we'll get inflation. The simplicity, the superficiality, the ignorance of most of the people spouting off about economics in the press and on Twitter and everywhere else has continued to astound me my entire career. When I was in my early 30s and I had just gotten divorced, I made a decision to go back and reread everything that I was supposed to have read in college. Notice what I was supposed to have read in college. And most of it I did read. I just didn't get it at the time. But with 10 years, give or take, of experience, some perspective, I reread Keynes' General Theory. I read Schumpeter. I read all the other economists again. And I took a look at the history of the United States, took a look at the great collapses that we've had. I reread everything. It took me 3 years, 4 years, 3 or 4 years. I re-educated myself with the benefit of perspective and experience. And at that point, I still had that chip on my shoulder, which every now and then you get a hint of. And over the decades, and especially now that I see a new generation of investors, and they're just like I saw in 1999 when some kid told me that I was obsolete because he could trade online now. And I ended up dating his ex-wife a couple years later because she got sick of his shit. I will tell you that the fact that retail poured into the market on Friday tells me they don't have a zucking clue. The people rationalizing that suddenly Trump's going to cut deals and everything's going to go back is monumentally broken to me. I don't understand how people believe that. And when you look at this chart, how do you rationalize that tax cuts are going to pay for themselves, right? I'm not denying that we need more sources of revenue. What I'm saying is that there's a right way and a wrong way, a way that pays for itself and a way that doesn't. And we're not talking about the ways that pay for themselves. So it absolutely could get worse before it gets better. Again, I don't know if it will, but you should be aware of that before you decide I'm going to invest capital. So I popped up some of the trades that I made on Friday. I have about 10 more orders in. They are strike prices that are about 10% lower and with premiums of at least 10% against the strike price. So I'm trying to build in a 20% margin of safety on all of my trades. And I'm going to fail, but I'll be closer than most people. So New Fortress Energy, the stock dropped through the floor on Friday. The order is triggered. I got $2 to sell $8 puts on New Fortress Energy, which is monumentally misunderstood. I don't know when the market will love it again, but I know that a net price of $6 is a stupid cheap price. I got a 25% premium, $2 into $8. You see that? Unity, I got over 15%. Flagstar, I got over 10%. Katera, what did I get there? 7%? About 7%. And then the one that I was a little surprised hit, but it dropped a lot, and I'm underwater on it now, is I got 10% on those tan July puts. Now, notice the time frames, May, June, and July. And the fact that I actually went out to July on a couple, which is a little unusual for me to go out that far. June would normally be the thing. I sold these puts on the idea that we get a rebound rally. I don't know if that rebound rally will hold, but what I just did is I used volatility to generate huge premiums, and you can annualize those. You can see that they're big premiums on the annualized basis. The smallest one is the annualized 20-something% I get on Flagstar. If I end up owning these things at those net prices, I'm A-okay with that. I will just go on vacation for 6 months and I will come back and they'll either be higher or starting to go higher. And I think you need to think that way. I think you need to think about 6 months, a year, 2 years out when the daily news is shit. Okay, the daily news is shit. Should I be depressed? Or should I say, well, we were really heavy in cash? I mean, anybody who wasn't really heavy in cash, okay, you didn't listen. That's fine. Now, even though there's a set of decisions to make, put the past behind you, right? Just like the Lion King, put the past behind you. By the way, I hope everybody watched Elton John and Belinda Carlisle yesterday. Is that who that was? Did I have her name right? I hope so. In any case, I think that you can try to make all these trades. If you can get a higher premium than I did, have at it. I picked these strike prices for fundamental reasons. If the technicals make them a little cheaper, so be it for a little while. If you can get higher option premiums, get them. I don't think you need to change the strike prices, though. Just take the higher premium, because ultimately you want these things put to you. If they get put to you that low, you'll get a rally you can sell covered calls on, even if you don't want to own them long term. I want to talk about, and I'm not going to show the stocks. I'm going to edit out the spot where I did show them. I want to talk about the punch card stocks, right? So I go through here. I kind of give you my quick take, right? You want to focus on shareholder yield. So you want to find companies that are buying back shares or paying out dividends and are reducing debt, some combination. And here's the secret sauce. When you screen for stocks, and go ahead and use Seeking Alpha. I'm going to leave this here so you can see what I'm screening for. Screen for 3-year total return. This isn't exactly my go-to list, but screen for 3-year total return. Why? Why should you screen for the companies that have done the best the last 3 years? Pretty easy answer. They're probably going to be in the group of stocks that do best for the next 3 years. That is almost always how it works. Now, I also take a look at 5-year, but I think 3 years is more instructive. You got to remember, 5-year covers COVID, which was an anomaly. It is hard to quantify for that, and it is not normal. So you kind of have to throw it out. So you'd have to go back to well before COVID, 2000, start of 2017, or just look at the last trailing 3 years, which I think is good enough for most folks. Now, if I start pulling out some of these, the important one here is revisions. This is what Zach's always used. Revisions are remarkably important. And in fact, you can even make the profitability a little bit worse because they can become profitable. You have to have some foresight on that. So now all of a sudden, your list expands. You start to get more companies in here, and you start going through them. Now, this one is a dividends over 2.5%. You can rank by different things. Now, I go through these companies, and you'll notice that on my list, not many of these are on there. Some of them are, but not many, right? Just randomly touching some of these. You go through it, and you start using the shortcuts. You go, okay, this looks like it might be interesting. Let's do some reading. You take a look at, and I'll give this company away. I'm not buying it right now. Take a look at Hercules Capital, business development corp, private equity firm, not very engaged in private credit, which is good because I'm not a big fan of the private credit underwriting. It's hard to quantify at a minimum, and it might just be outright bad. Hercules specializes in fourth industrial revolution, venture capital, secondary funding. So stuff that's gotten off the ground already has money in it, just needs more money. Fourth industrial revolution, we've talked about that before. And I like these guys as a complement to really big, like stone strong private equity firm that I'm recommending on this correction. When I built this punch card stocks list, which is up to 20 stocks that I'm really on my A list, a few of them are limited partnerships, so you can only put them into taxable accounts. And then I have 7 on my watch list. And I'll talk about one, Dow Chemical. Boring company. But paying a 7% dividend, that dividend has like no chance of getting cut. I mean, the odds of it getting cut are really, really low. So the cash flows are becoming very cheap on some of these big dividend payers. I haven't talked about a chemical company in 7 or 8 years, I think since 2018. And suddenly, some of them are just in those multi-year troughs. And you can say, okay, if I'm a dividend investor, what's attractive with Dow Chemical to me? And it doesn't even make my screen because it hadn't really performed well. But it's not a turnaround stock. You just look at it, it's just been a choppy stock for a long time. And then it fell off a cliff here recently. And suddenly it has a dividend yield approaching 10%. You think to yourself, okay, can it go down to 20? It can go down to 20. The market's that bad. How safe is that dividend? Well, you can go to the dividend tab and see that it's a pretty safe dividend. The odds of us really seeing a breakdown in their dividend is pretty low. So let's go back to, right? They don't change the dividend. Even during COVID, they didn't lower the dividend. So this is a pure mathematical calculation. Am I cool getting about 10% on my money for something that probably at least gets back into the 30s, well into the 30s, maybe 40, right? Hard to see it not getting actually really to around 50. So I think with this one, you can collect 10% and someday it'll be 50 again. I don't know if that's in 3 years or 8 years. I don't know. But let's say it took 10 years to double your money and you're collecting a 10% dividend. It means you've doubled your money again. So if I told you you could double your money twice in the next 10 years on Dow, would that be good enough for you? Because that's probably what's going to happen. Maybe it's faster. Maybe it's a little slower, but I don't think so. I think for the dividend investor, this one's pretty easy. Let's pull up the options, right? That's what we do here. First of all, let's take a look when the next ex-dividend date is. So about May 28th. So we want to try to sell the May options so that if it gets assigned to us, we collect that next dividend. So I can sell the May $25 Dow puts, and I might do this, get about a 5% premium. And I don't have to buy the stock unless it drops about another 10%, right? I think that's pretty nifty. Collect $1.25, collect 5%, maybe a little more than that. To me, that's 6 weeks. So there's 8+ of those periods in the year. 5%-ish times roughly 8 periods in the year, right? 6 weeks, about 8 periods in a year. You have an annualized rate somewhere in the 40s on the dividend, on the premium that you're collecting. And then if you have to buy Dow at $25 a share, and just start collecting that 10% dividend while you wait for it to go to 50, pretty interesting. And this didn't make my top 20. That's how cheap things are getting. So if you actually take a look at what's out there, you can look at quality companies. You don't have to speculate. People ask me about Kohl's because we kind of sniffed around it for a little while. Why would you deal with a whole bunch of turnaround companies right now? How often do you get to buy quality on the cheap? Not often. Here's a chance. I do think I like selling these puts though, because at some point, and not for everybody, but I have certain clients it makes sense for. You have to decide if it makes sense for you. If you can double your money twice in Dow over the next decade, is that good enough for you? Let me math that out. That's a 15% annualized return. Would you be cool with a 15% annualized return for 10 years? Maybe it happens a little faster, maybe a little slower, changes the annualized return, but you collect 10% a year because they're not going to cut that dividend. They might not raise it for eternity. You saw the chart. They pay what they pay. There's a lot of ideas out there like that right now. I will say that the reason why 2 private equity firms are at the top of my list, and we've talked about this, is that a lot of the best assets are going private. And the only way for you to really get a piece of that is invest in private equity directly or buy some of the private equity companies, KKR, Blackstone, Apollo, and then understand where they get their cash flow floats from. They all have interest in insurance companies, right? They're kind of mini Berkshires. They suck more money out than the Berkshire people do. Got to be aware of that. Let's take a look at Berkshire Hathaway. So I saw hundreds. Oh, Berkby, duh. I have seen hundreds of people posting about Berkshire Hathaway. Let's actually pull it up here so it's easier to look at. Actually, let's compare it to SPY. It's just, yeah, that's a good time frame. There you go. So Berkshire Hathaway against the S&P 500 going back to 2016. And I actually think the relevant time frame is 2017. They're almost mirror images, right? Except that in a down market, Berkshire does better, right? Because most of these years are up. And lately, Berkshire has passed the S&P 500 by. Now, will the S&P close the gap on Berkshire? I don't know. Berkshire has a lot of dry powder that they can deploy here over the next year. Probably in a few weeks when you start seeing the reports, right? Every quarter they file, you'll see what they started to buy. I don't know that they're going to have bought a lot in the first quarter, but I bet when they report in July, you're going to see that they bought a lot of stuff in the second quarter. So ask yourself, what do you think Berkshire Hathaway is buying? Okay. And if you are somebody who likes to have some of your money in the S&P 500, I would say to you, cut it out. If you want an S&P 500 proxy, buy Berkshire instead, because half of the companies they own are just private companies. And then they go out and try to cherry pick the S&P 500, which they're pretty good at. They, even with such an enormous amount of money, can beat the S&P 500. But if you just think about it as a tracking stock for the S&P 500, but with a big pile of cash ready to deploy during any crisis, it's a pretty good core holding. So instead of having SPY in your portfolio, own Berkshire, and then find ETFs that will do better than the index, like the momentum ETFs, QQQ, if you can get it close to a bottom. My problem with QQQ, and I haven't actually pulled this, I've done it before, and I forgot which one I landed on. I would like an ETF that is basically QQQ without 4 or 5 stocks I don't like. So I got to figure out how to do that, because I truly think that Tesla is not done going down yet. I could be wrong, but I've had Tesla pretty nailed for a long time. I had it on the way up. I shorted it. I've understood what's going on. And now they have the problem of people hating Musk. So a lot of the cars that people would have bought, it's just not going to happen, right? He has inflamed liberals so much that, and globally, the Europeans, the Chinese. I mean, I can see really bad news coming out of China with regard to Tesla, like they kick them out. The way their contract is set up in China, they can kick them out pretty easy. So we'll see what happens there. But all the narratives about Tesla have proven to be wrong. And I don't know why anybody would believe them at this point. Robotaxi. Oh, yeah. Nobody's going to compete with them on that. Waymo, Uber, right? Robots. Nobody's going to compete with Tesla on robots. Rockwell, Siemens, right? You go right down the list. They don't have a single business where they're going to be number one. They're not even going to be number one in electric cars soon, because the next electric car comes with a 3-gallon gas tank to recharge it on the fly. Will Tesla do that? Will Tesla adopt the EREV after being a pure play, no gas and oil? I don't think so. Maybe they shift, right? Maybe that's part of his new ideological affiliation. We'll see. One of the things that I'll finish with then, or the thing I'll finish with then, is take a look at all the energy stocks that I put on the dividend list. I think there's 6 or 7 of them, 8 of them. During recessions and recessionary scares, energy stocks get crushed. So let's take a look at XLE, right? We don't need to compare it with Berkshire. During recessions, XLE gets crushed. We saw it fall here, right? Big drop. We thought there was going to be a recession here. So this is a recession scare, not a recession. And it's also the Saudis flooding the market with oil. COVID, big rally. If XLE gets into the lower 60s, I'm not saying buy this, but that's your signal to buy the other energy stocks. The odds of it dropping below this trend line, it can go all the way down to here. Somewhere in here is probably where it bottoms. But when this gets here, you can probably start selling puts on those energy names, or start nibbling them if you believe the yield is secure. And the companies I put up, I think that they are, right? A couple of the companies have adopted flexible yield, a very small yield, a very small dividend, and then a variable dividend. So in the years where the variable dividend is going to be low, or the perception of the market is that it will be low, the stocks get real cheap. And that's when you buy them. You buy them when people hate them. I don't think the blood is all out of this market yet. I think there's more blood to come. There'll be rallies. People will yell and scream and stomp their feet and pound their chest and right, they'll do it. Second half of the year, we have to figure out the debt situation, and it's going to be a monumentally difficult problem to tackle. Ultimately, they do quantitative easing because they don't want a depression, and then they just deal with the inflation down the road. And I'll remind you, if you need reminding, I know some of you on here I can see don't need reminding, but others haven't really thought this through because it's new to them. But since George W. Bush, and really even a little bit under Clinton, the idea that we would have to inflate our way out of the debt has been there. The idea that we would see inflation specifically to devalue our debt is a long-held theory, and I think a lot of politicians are just fine with it because what do they care? They're getting paid on the side. And let's face it, a lot of them are getting paid on the side by their big donors. So don't think that that chart's not about to turn over, because it probably is. This isn't just volatility anymore. We're in a bear market. How far down? I don't know. If it drops about 10% from here and then it holds, great. But I think that the broad index has about 20% lower to go, and it could be worse. We'll see. Now, by the way, there was a rumor, because not everything on the internet is true. Just want to let you know, not everything on the internet is true. People talking about an emergency meeting by the Federal Reserve today. There is no emergency meeting by the Federal Reserve today. They have a regularly scheduled closed-door meeting to discuss some sort of rate refining or rates and refinancings that they, do. Just a normal meeting. They all go have lunch. They ask, is anything broken? Are we going to be able to do this? They say, yeah, sure. They probably talk about what's going on. They probably make some pretty rude jokes. They have their sandwich, and then they pick what color tie they're going to wear. There's no emergency meeting. The next Fed meeting where something can happen is May 7th. And I think, and remember, I wanted them to lower interest rates a year ago, even with inflation, because I wanted to see the building boom continue. I guess they're just waiting to stimulate building until they absolutely have to, because a building boom will pull us out of a recession. But the 5-year has to come down to 3%, which means that the Fed funds rate has to come down to about 3%. I think they get to 3% this year. What are they at, 4.25% right now? I think they get to 3%. I think they start on May 7th. That also will coincide with the reconciliation bill, give or take. And when they do the reconciliation bill, they will lift the debt ceiling. And that gives the Treasury some time, or it allows them to use their balance sheet again. And you'll get a 2 to 4 month pop. I talk about that in the article today. I'm going to try to get a full outlook out before I leave tomorrow. But the abbreviated version is in the punch card stocks. And I'm going to get my growth list out next week because there's about 5 new stocks, one that could fly, and a few others. So focus on these dividend payers, though. I think that this is a rare opportunity to get some cash flows on the cheap, and start by selling cash secured puts. I really, really, really want you to sell cash secured puts, and so does Fred. If you're not selling cash secured puts, you're not selling options, do the reading tonight. Stop putting it off. Do it. This is just the most incredible way to generate income. And if you take a look at the dividend calendars, you can game the system. You can get extra income and lower buy-in prices. It's beautiful. It should be easy to average 10 to 15% total return. Easy, with less risk than the S&P 500, right? That's an S&P 500 return with less risk. It's the golden goose. Now, I'm shooting for numbers in the 20s, but if you take the conservative end of what I'm showing you, 10 to 15% with less risk than the S&P 500, and keeping the upside of equities, which really benefit from inflation, it's a good deal. All right, everybody, have a good day. I have to go get my real ID. I'm going to Phoenix tomorrow. Hopefully see some of you in Chandler at Eggs and Joe, or Joe and Eggs. I think it's Eggs and Joe on Thursday at 9 a.m. Arizona time, whatever the heck that is now. All right, take care, everybody.